You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by Quikstrike, options pricing and analysis software. Quikstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quikstrike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quikstrike is the perfect addition to your trading toolkit. Learn more about Quikstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quikstrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time once again for TWIFO. This Week in Futures Options, as the name implies. This is the show where we break down all the cool stuff that's lighting it up on the futures options side of the fence. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And, of course, you can find all of the great archive episodes of this program, as well as the other 14 programs on the old network. Easiest place, the mothership, the flagship, theoptionsinsider.com. While you're there, click around, read some interesting headlines on the world of options, some unusual activities, some breakdown on futures. You got some of that over there, too, as well as all sorts of other fun stuff, a lot more stuff leaning towards the futures options side of the fence, as you guys are just clamoring for more and more content on all of those products, crude, and on corn, and on gold, and on silver, and beans, and everything in between. That's why we got a whole program for you devoted to just that. Of course, you can always find us as well, iTunes, TuneIn, Stitcher, all the fun places, including via the app stores where our mobile app can be found for iOS, Android, and the Fire OS. So make sure you check it out. And while you're streaming, speaking of streaming, I always forget to make sure you can always tune in and join us live every Friday, 3 p.m. Central, 4 p.m. Eastern, via Mixlr, MIXLR. Just grab the link via our Twitter account whenever we tweet it out, or just if you have it once, you can just bookmark it in your browser. It's the same link every week, every time. Whenever we put a show out live, that's our link. That's our page over there on Mixlr. And if you follow us on Mixlr, then it'll just notify you instantly. The second we're going live, you can always do it, obviously, on your device of choice, not just on the web. So you can do it on your mobile devices as well. We welcome you guys in there. We like a little nice, raucous crowd in there with some questions, some comments, some pearls of wisdom for us over there in the room. Speaking of us, it's not just me on the old program. No. I'm also joined by my futures options compatriot, one Nick Howard, the founder of Bantix Technologies and the creator of a little platform we like to use a lot around here called Quikstrike. Mr. Nick, welcome back to the TWIFO program, sir.
How's it going, man? Do I have to mute and unmute myself, or are you going to take care of that for me?
Are you referring to an earlier episode on our network, sure, sir? How dare you malign some of our hosts who are, shall we say, mute button challenged? And we are working with them to build a big red button onto their desk so they can just handle it a lot easier for them. But yeah, we try to handle most of the.
Should I control myself or no? No. Are you going to mute me, or do I need to mute myself as I come on and off?
I will mute you, sir. Don't worry.
Thanks.
Do not worry. I can handle the muting on our end. We're pretty high end over here, Mr. Nick. We can handle a lot of fun stuff, including, of course, a deep dive. Let's kick it off into the world of all things crude. By the way, you guys listening along either live or after the fact, if you want to make your own cool reports and analytics, don't just take our word for it. You can look at it yourself, generate whatever the heck you want. CMEgroup.com/TWIO. This week in options. That'll get you access to all this stuff we're talking about completely for free. It's kind of ridiculous if you ask me, but c'est la vie. Head on over there. You can talk about all this stuff we're talking about: volume, open interest changes, skew, at the money vol, other vol, you name it. You can really break it down. So if you want to get some futures options analytics, I'm guessing if you're listening to this show, you probably do. You should be on that link as we're doing the show because you can follow along with us and maybe find some of your own nuggets over there as well. Let's kick things off then in the realm of WTI, as we are wont to do. Nick, it's been another active week in crude. Since the last times we talked, the futures are up about 2.5 handles, vacillating right around that 45 or so level, 44.5, 45, depending on where you're looking out there on the term structure. Of course, a lot of that was buoyed earlier this week by the Saudis maybe hinting at long last, maybe they're going to finally step in and support these prices here a little bit. People have been waiting a long time to hear that out there right now. So, of course, that gives me a little bit of a bump after WTI briefly flirted south of the 40 handle. Now we're back in that mid-40 range. Of course, we talked a lot on the program about how people were leaning to the downside as a result of that, and that seemed to pay off. And now here we are back up in the mid-40 handle. And once again, given all the near-term vacillations we're seeing out there, once again, the lion's share of the paper is still out there in that front month contract, that SEP contract, which is, can't really call it a month. It's more like a weekly now. It's got about less than 5 days actually to go at this point. So interesting stuff out there. About 63% or so of the paper, a little over 500,000 contracts coming just in that front term. And as you break down what was lighting it up, what was leading the charge, what was the most active option, the most active strike out there in WTI, you can probably guess, if you've been paying attention, you probably guess where in the strike chart that came, certainly front month, and certainly around that 40 handle. That seems to be where the most mind share has collected over the past few weeks or so. And once again, it was a 40 handle. This time it was the SEP 40 puts that were leading the charge with a whopping 62,000 contracts out there open with a pretty wide margin. Also trading fairly evenly throughout the week, Nick, as well. It wasn't like there was one big burst of 30 or 40,000 contracts on Monday and then kind of the rest throughout the week. It was fairly even, a good chunk, about 20,000 on Tuesday, and then about 13 and about 14 again on Thursday. So it was pretty even across the board, about 8,500 so far today. So it was a pretty active contract all week long. Number two, pretty far off, but still pretty active, were the SEP 45 calls. Again, showing, particularly this week with a bit of a rally in the underlying, the calls showing a little bit of love here, about 42,000 contracts lighting it up there. Another one where a lot of activity all week long, not just earlier in the week or on Wednesday when we saw the comments coming out, but even 11,000 going up again today. So people have been piling into those calls quite a bit as well. Then once you get past those two, the SEP 40 puts and the 45 calls, it kind of falls off a cliff. You get up to the SEP 46 calls, and they did about 28,000. So those were the two lion's share. And that also reflects what we've been talking about with the volatility skew out here in WTI as well, where longer term it was favoring the puts, but in the very near term, the front month in particular, it was kind of a coin flip. It was very symmetrical out there over the past few weeks as people were piling into both calls and puts with almost equal measure as people were kind of trying to feel themselves out what was leading the charge out there. And speaking of the charge to the downside from a volatility perspective, with most of the months coming off a point, if not two, or sometimes close to three, depending on where you're looking again out there in the term structure with vol coming off. That kind of is not surprising when we're talking about, again, longer term. The skew does favor the put, so a downside move should give us a nice little boost in volatility. Upside move, volatility should come off a little bit, and that's kind of exactly what we're seeing out there in the volatility across the board. Mr. Nick, yeah, looking, it's funny though, if you look very, very near term, Nick, in these effectively SEPs, which are now weeklies, you'll see that there is a nice strong bid still to the calls. So people, at least in the near term, have been getting them some call love in across the board. But I know you also have that cool quick skew going on over there, Mr. Nick. So perhaps you can break down the WTI quick skew for us, as well as what else was catching your eye out there in WTI this week. A lot of stuff to chew on this week in the land of crude.
Yeah, let's see what we got here. So the September contract, it's always hard to talk about it when it's just 5 days left to expiration, but I did push something out on Twitter so you can take a look at something that'll be available this weekend on the CME website, where we mark the max open interest call and put. So there's a theory out there, I think in particular in the stock market. So we'll give it a try and see what it looks like in the futures market, where you tend to get bounded by the OI on the downside and the OI on the upside. So right now we have the 40 strike and the 50 strike in the September contract. It's a little bit different as we move out into the October and the November. But wanted you guys to all take a look and see that new report, and you'll be able to see that along with what a lot of people call the Max Payne report that will be released as part of the Open Interest Profile tool as well out on the CME website. So that 40 and 50 strike, that theme seems to carry fairly well in the November contract, as well as September. And October, it's a little bit different. The high side open interest is on the 44 strike. So we'll have to watch that and see how it plays out over time to see what we think and if those are going to be useful metrics for us. But as far as the WTI in general, we have about, I'll repeat some of the stuff that Mark probably mentioned. Another increase in the open interest, about 100,000, so reaching well over 3 million overall. Generally, a pretty evenly distributed put call and put and call buying. So the ratio this week with the volume is about just a little bit over 1. So market's still sort of trading back and forth, making up its mind which direction you think it is. And again, like Mark said, you start to move up, you move down. We're kind of trading in a little bit of a range here. So there's not a lot of sentiment one way or another, I would think, just from a practical standpoint, which way I think you're going. Mark mentioned the Saudi support. So we'll see if that holds in terms of us getting our movement on a continued upside. Anyway, as we mentioned, 40 put and 50 call, still the major barriers in there. 45 strikes merging as well as a pretty solid contender in the open interest category here. So, again, as we start to trade around this strike, or it becomes a low or a high, depending on what the crowd feels is the final direction for the underlying, we'll have to see how that plays out in terms of it establishing itself as an upside or a downside on the range. On the November contract, we see something a little bit different than we are overall in the market. We see that, that it's tilted more towards the put buying, right? So the put call ratio up over about 1.7. And interestingly enough, 20% of the volume in that November contract was for the 50 call and above. So we're talking about not just the 50 call, but we have the 50, the 52, the 53, the 54, even the 60, and all the way up to the 65. So some sentiment out there long term, potentially that market's looking for some upside, especially out past the October date. Other than that, let's see. That's really, if we're just looking at the ratios, that's really the only expiration that had any real directional bias, and that had some let's see what we got. The November had the greatest increase in the open interest as well. So, some of that September OI is going to start rolling into October, November. December is always a pretty big contract. The June into December are always pretty big open interest contracts in the crude. So that's what we see right now. So again, like we say every Friday, and I think I'll say it again, that's the fun of doing the show on Friday. We sort of see where things continue. So, not really sure. We should probably do some views as well, what we think, and see how wrong we are the following week or how right we are the following week. But anyway, that's what we're seeing for the options and the open interest, the volume, and interesting strikes.
Oh, great. More opportunities to embarrass myself on the network. So I already spend the morning guessing VIX for the week ahead and a lot of other equally, shall we say, flighty type products. You want to add crude and a bunch of other things. We could do that too. I'm open for more opportunities for embarrassment on a regularly level. Let's move on. Speaking of embarrassment, this one hasn't been as crazy, but still an interesting product to keep note of. And I know a lot of you guys do like to sink your teeth into this one. Sometimes literally when you're checking the quality of those nuggets. This is the shiny stuff. This is gold, and another interesting week off there. The future's off a bit, not crazy this week, but off slightly this week. And we saw a lot of paper come lighten up again this week with about little over, just a tick over half of the overall volume this week coming in that front SEP contract. And then overall, open interest also ticking up a little bit this week as well, about 2.5%, which is interesting in and of itself. Not a lot of stuff out there aside from some of those numbers we saw earlier this week. Of course, we saw the big non-farms number last week, which we didn't really see. I think a lot of people expected maybe a little bit more of a response in gold. Didn't really see it. We saw somewhat a bit of a muted response net this week. So it's kind of interesting to watch gold in these weeks now, subsequent Brexit, and see what's been driving it. Of course, we had the big flight to gold. Then people kind of weaned themselves off that a little bit, moved towards the puts, and the calls were in favor again. And now it's kind of an interesting little setup we have out there. Looking at what was lighting it up this week from an activity perspective, which strike was leading the charge. It was the SEP 13 halves, which were fairly evenly active throughout most of the week. They did about a little over 4,000 contracts total this week, so not a huge barnstormer by any means, but decent paper for these. These are, again, the big COMEX gold contracts out there. Again, it was pretty evenly split throughout the week with the exception of Tuesday, which was a fairly light week, only about 300 some odd contracts. And then number two was, again, people like these even round numbers, and we're right in kind of split in the middle of this range. So 13.5 call on the upside, SEP 1,300 put on the downside, also getting some love with about 3,400 or so contracts. Again, fairly evenly split across the board all week long. So that's kind of interesting. On the upside, though, people were also picking up some 1370s as well, which about 3,000 of those trading throughout the week. So the gold bugs still out there in force, still fairly active across the board. And looking at this, of course, from a vol perspective, vol off slightly this week with at the money vol off, pretty much about half a point to a point, depending on where you're looking out there. Not a heck of a lot going on skew-wise either, which is kind of interesting. I can let Nick dive into that a little bit more because he has the quick skew up and running on his system. I don't have that right now, so I can't do all that cool stuff that Nick can do by looking at the put wing and the call wing independently. I'll set that up again after the show, so I like to look at that as well, listeners. But looking at how the skew is lining up from across the term structure out there into early next year, and it's once again calls are leading the charge, but it's by no means the call frenzy that it once was. In fact, near term in that front month / kind of weekly now, it's pretty much symmetrical. Calls and puts having equal amount of love, again showing a bit of ambivalence in the near term as to where this thing is actually going. Longer term, slight bias to the calls, but nothing particularly egregious. And as we're looking out a little bit further, that seems to be kind of the shape across the board. Mr. Nick, I know you like to watch the shiny stuff as well. What's out there was catching your eye this week, sir?
Well, I think something to keep in mind too, and originally when I was looking at the report, not having paid a whole lot of attention to that particular market this week, in and of itself, you gotta. Right now, we're only showing that it's slightly off on the week, a couple bucks, $2.5, but it had some really good ranges the last couple of days. So that's some other indication of why vol might be in a little bit as well, right? We go higher, we come back into place. We go higher, we come back. So as we start to establish again a trend, you're going to see vol come off a little bit. But with that said, if you look at the trend in the gold vol itself, we had a period of time a little while back where it was a little bit higher, but the general trend in volatility is down. And we have another measurement on the pricing sheets in Quikstrike that we call rent, and it's basically how much does the underlying have to move in order to justify the current volatility levels. And right now, I think the front contract rent is about a $12 move. So, we had enough movement the last 2 days to justify these volatilities. So from my standpoint, again, I should give some historical bias. I have some historical bias. I tended to be, I believe it or not, just based on the whole world of volatility, I tended toward a long volatility play, looking for cheap volatility plays as opposed to always being short. So when I was working for the institutions, I was more oriented towards being short, and then I was on my own or in smaller groups, I was looking more for value and trying to play value that way and look to trade in and out of that. So generally, I'm looking for volatility levels that are attractive, and to me right now, gold looks like it's fairly attractive from a vol standpoint. There's a downward trend. The movement in the underlying is still sort of really supporting that volatility. So there might be some opportunity there. So if you're a gold bug or you trading options, you want to trade options, you might want to take a look and see what that historical volatility looks like, see that the trend is down, look at the futures and see that it's actually moving, that kind of thing. So that's sort of my first impression. But like you said, not a lot of craziness in terms of strike range or anything like that. We're probably staying in the 13 to 1400 range in the trade, and that's what you're going to get when you're in a bit of a range. So until we break outside of that, I don't see anything too interesting other than the fact that I think vol seems a little bit low. The skew is sort of in line now, so meaning that there's a little bit of bias to the call side, but it's even more or less. It's not too. Might be a one vol more expensive for the calls, 25 delta calls, than it is for the 25 delta puts. So that tends to make me also start to think that there's some equilibrium being established, but there also vol is low, skew sort of steady or even. So there might be some opportunities there to play a direction or to play a big move in terms of increased volatility or movement in the underlying. So my general note there is there may be a long vol opportunity coming soon. And again, that's from a guy who's not trading, who's just watching things, who used to trade, who has a perspective just based on the numbers and the volumes and the open interest and that type of thing. And looking at the ratios from both the volume and the open interest standpoint, those ratios are still tilted toward the calls. And just to sort of keep our theme going, our high OI put in the front contract, which has about 13 days left, is the 1300 strike, and the high OI call is the 1500 strike. So again, if we're just sort of conjecting on where we think we probably have a range 1300 to 1500, that's not really going out on a limb very much, but if you want to tighten it up, you could say 1300 to 1400 just based on the next levels in OI, even as tight as 1300 to 1350, because 1350 is the next upside call that has the greatest OI. So pretty well bound in terms of, at least from a practical standpoint, of where we think this thing's going.
All right, sir. Thank you for that. And let's move on. Product category, we don't hit a lot on this show, but it's kind of worth, I think, checking in on every now and then. And certainly this week with a new all-time highs being set almost seems like daily, it's worth checking in on all things E-mini. E-mini, of course, being a very popular way for a lot of people out there to trade their S&P. E-mini S&P, obviously, is what we're talking right now. And before we get to that, Nick, there were some interesting nuggets we found here playing around with the Quikstrike before the show, and we put out. It was so surprising to us, and maybe we thought it would be surprising to our listeners as well, just how the volume breaks down in the E-mini options. E-mini options is effectively, as you know, Nick, have effectively three different components. They have the weeklies, they have the regular traditional monthlies, and then they have what are effectively the end of month type options. And one product category lights it up over the other two. We thought it'd be interesting to ask our listeners, kind of do a little quick pop quiz as to what they thought was lighting it up. The pop quiz, I think it has a little bit about an hour left. It was a very quick time period. But so far, the early voting here, Nick, what do you think is, don't cheat, don't look at Twitter. What do you think our listeners voted for? What do you think is winning?
I bet that it depends on what perspective they're taking, right? So from a volume standpoint, if they're looking at it from, what's trading, what's going to be active, they're going to pick the weeklies. But if they look at in terms of what's going to have highest open interest and stuff like that, they're going to say the quarterlies. So let's go with the quarterlies. That's what I'm guessing.
Okay, so your traditional, regular, old monthly option. That's what you're thinking.
Sure, that would be. I'd say even though would be my guess, just because I can cheat, but that's what I'm thinking.
Yeah, that was leading the early voting, but then the weeklies came up hard, and as we are recording this now, with about an hour left here, even 50% coming in for the weeklies. So some savvy people out there. 42%, very close to the monthly / quarterly, however you want to view them, the serial type months out there. And then 8% coming in for the end of months. So easy way to find out that answer, Mr. Nick. I'm clicking over here to the E-minis and looking at that old TWIFO report. You can find that in the tab. The listeners, or again, go to that cmegroup.com/TWIFO for yourself. And it is surprising because we talked before, I think we had a listener question last week or the week before, Nick, about why the short-term stuff, the weeklies in WTI don't really light it up. That's not really the case in the equity indexes. It seems like all things single-name equities and broad equity indexes, people just love the weeklies. They can't get enough of them, and they have been lighting it up yet again with the weeklies doing over the past week about a little over 600 some odd thousand contracts. Excuse me. And the broad quarterlies, or call them what you will, the monthlies, I think that's how we term them in our poll to make it a little less confusing for people, about 460-odd thousand out there. So pretty active weekly component out there. And if you're curious how much those end-of-month trade, they actually do all right as well, a little over 200,000 contracts lighting it up out there as well. But yeah, weeklies still crushing it. From an overall volume perspective, again, showing you just in the near-term equities, people got to have their weekly. That's probably another reason why we saw the rumored launch supposedly this Monday of a Monday weekly coming out on the S&P as well, the SPX. So we're seeing a lot of love. There's a Wednesday weekly in the SPX. There's a Friday weekly. Going to be a Monday soon. Very not that long until we have every day of the week covered. We effectively have dailies out there. I wouldn't be surprised to see CME following suit in some capacity as well very soon. So clearly, at least on the equity and index side, there is a lot of demand, a lot of love for very near-term, bite-sized type contracts, and E-mini lighting it up as a result. If you're wondering, you're saying to yourself, hey, what was lighting it up out there from an overall volume perspective? What was in this week of all-time highs all the time and all sorts of new stuff going on out there? What was the big volume leader? Well, maybe surprise. You might be surprised, maybe not. It was the 2210 calls actually out there in the weeklies, at least, that were the big volume leader with about 13,000. They were followed very closely by the 2130 puts. Again, all there in. These are expiring on, I know why these numbers changed, because I had the numbers there. They expired a little while ago. Just the ones that expired today, they just rotated off the board. I was looking at those. The ones that expired on today, the 12th, actually were the overall volume leaders for the week with about 27,000 of those 2170 puts. So it was downside, actually, that was leading the charge with about 12,000 of those going up today alone. Again, they expired today, so those are now knocked off the board. And then we fast forward to next week, expiring on the 19th weeklies, and those 2210 calls also lighting it up with about 13,000. We also saw puts or call options expiring today, so the 2180 calls and the 2160 puts also fairly active, both doing about 20,000 and 23,000 contracts respectively. So weeklies going out today, we're lighting it up. Again, OI on the weeklies is up strong as well, up about 13% versus the monthlies, where the OI is also up pretty strong, up about 7%. So it kind of goes back to that old adage, people like a bull market, and they like their options in a bull market. Even though vol's coming off, people are still piling in to these E-minis in serious numbers out there, which is kind of interesting. Looking at the volatility skew, again, we talked about this on recent shows as well. A volatility skew in the equity indexes is not as not as variable of a thing as you see in some of the other commodities like a crude or even a gold or others. It's going to be that straight up investment skew. Puts have a premium, calls have a discount. What degree that is kind of varies week by week and month by month, but in general, that's the relative shape. And we've seen a little bit of a little bit more firmness out there of this week overall in the skew. But again, I don't have the quick skew up right now, so I can't dive full into that for you. On the big monthlies, what was lighting it up was the 2,200 calls, with about 15,000 of those bad boys going up over there. Nick, I know you're more of a rates guy, so I'll toss it to you now for your rates breakdown, unless you have anything you want to add about the E-minis. But I have a feeling it's not the last time we'll be talking about the E-minis on the show. I wanted to just get it in there this week because there's so much talk about these levels here in the S&P and what does that mean for everything. Worth at least casting a little bit of light over there on the E-minis. But let's turn attention now to your neck of the woods, the rates. It could be treasuries or Eurodollars or maybe both. I'll let you pick your poison, sir. Have at it.
So I'll throw an E-mini thing out there just for the heck of it. I think that I did look at the quick skew, and you should have it. It should be enabled now in your stuff in Dev, so you could take a look and see. But you're right. There's not. First of all, you're not going to see sort of the back and forth in the quick skew in the short dated stuff because there's really not enough time frame to look at anything interesting from a historical standpoint. But I did look at longer dated, quarterly or monthly, however you want to term them, and hoping to see maybe some fluctuation in that quick skew in terms of how rich or cheap the puts are to the at the money, and really there's not much. So it's almost like there is a baseline skew, which everybody knows there is. Like you've talked about it in investment bias and that kind of thing, and the portfolio bias, whatever, when they're hedging when the hedge funds are hedging the books and stuff like that. So there's really not a lot of change or action. So it's probably worth keeping an eye on that. So if you do see some fluctuations up or down, then maybe there is something that is available from an opportunity standpoint. But the only other mention I might want to make is like in the week 3 contract expiring next Friday, there was a big change in open interest for the 1750 puts. So those traded this week about, let's see what my number says here, about a total of almost 8,000 times, and it looks like most of that was opening. So more than likely people coming in there and doing some selling in that strike. Once we got the rally, maybe there was a little bit of meat left in that strike before the last push, and somebody got rid of that and is hoping that it will, and more than likely it'll decay before expiration. So anyway, jumping over to the rates, we could take a look and see. Let me get my screen to switch over here. So I'll start over in the 10-year, just because that's a good place to start, and it's what people talk about. That's what they mention on Bloomberg and all the news. So anybody who was watching today saw that there was a weak retail sales number as well as CPI and PPI that were negative. So no inflation to a downward trend in inflation just for that period of time. That's sort of the first thing, and that's going to give you an idea of where that upside in the futures, downside in the yield, right? Because they're inversely related. That's where all the movement in the 10-year and the Eurodollars came from, is on that report. And I think that might have been where the spike in the gold came from as well. There was a spike today around that same time, so it could very well have been a reaction to those numbers. But I'm not entirely sure. That was just my guess based on looking at the clock or the timestamp on the price movement. But anyway, let's see. We got. If you look, you're going to see on the report, and you're going to see something new in the report this weekend. So go ahead there and take a look on Sunday. You'll see another green line in the TWIFO report, because we're not only doing a blue line for totals that are on that part of that report, but also a green line for the total product. So let us know what you think about that. I think it's helpful. It's a nice comparison. But most of the upside in the futures came today by way of the number, and this probably puts another thorn in the Fed side after the jobs report sort of pushed them more towards being able to tighten again, and now you get no to low inflation and weaker retail sales and all that kind of thing. So now it's probably, and we have to look at the Fed Watch tool again and see if it changed at all from the last time. So that's probably some news that they're going to have to digest and see what they think and see if it changes their opinion at all. There's not much range in the range of strikes that traded. So again, it's another one of these markets, and you can call it the summer blues or the summer doldrums. We're sort of in this tightly bound area, and you're not going to see much, at least there wasn't this week, much in terms of a directional bias in any particular strikes being bought or sold that were outside the range. I mean, the thing we could talk about the most is probably out in the far December contract, which is has about 100 days to expiration. We saw some downside puts get opened up there. 128.5 strike got opened up. It traded. Let's see how much of that was. Yeah, so most of the trade was an opening trade, and then also 126 half put. So I guess there was some bias there on the downside. There were some opening strikes, and most of that took place on Monday. So again, wasn't aware of anything in particular that could have spurred that trade, but that's really the only thing of interest from a kind of a outside the range strike standpoint. Other than that, we have a move. A lot of the open interest is moving out on the curve, October, November, December. That's where most of the increases in the OI occurred. The September contract, which has about 2 weeks left, only up a little bit in OI. And if we add the weeklies to our report here, we can take a look and see how much trade occurred there. Let's see what we got. So, a lot of weekly expiring today. A lot of that OI rolled off yesterday, some rolling into week 3, which has about 7 days, and then not much going on in week 1, which has about 3 weeks, week 1 being the first week of the next contract month. So that'll be on the December contract that trades. So again, Mark, to your point, here's another product where the weeklies are trading pretty actively, and there's a lot of good opportunity there. And you get a lot of the same kind of volume in the active weekly that you would see in the first quarterly. Let's see, what else do we have here? The other thing, vol is steady to down a little bit, and the skew is pretty flat. So again, another market, rangy trade, not much bias one way or another outside of those long dated puts. So again, we're looking at. Let's see, you got the skew is almost flat, so probably some opportunity again. Take a look at the vol level, see what you think, see if you have any directional bias after some of this news comes out, and maybe we'll in the coming weeks we'll have a conversation about skew being pushed one way or another. You want to jump in there on the 10-year at all? You want me to jump right to the Eurodollars?
You can jump right into the Eurodollars. I'm getting queued. I'm getting ready for our listeners to dive in with the feedback, sir.
Yeah, so I think I give the same general comments about this as well. Not much in terms of futures move. Action all came on the numbers today. Big bias still on the downside with both the volume and the open interest. And, and regardless of the news that's coming out, we're probably going to expect this type of thing basically because we're butting up against the zero interest rate. So our action's got to be on the downside. There was one note. There's a big buying in the December 88 contract, so that's the 98.875 strike. About 500,000 contracts traded there, with almost 70% of those being in new open interest. So a lot of that traded as part of spreads. Trees, I looked at the list of spreads that traded that included that strike. Trees, regular put spreads, 1x2 squashes, which are risk reversals, butterflies, condors, and outright. So a lot of action in that strike. So people will do butterflies in order to position themselves for an expectation of where they think rates are going. Same with 1x2s and trees, condors as well. So a lot of action in that strike, and that could also be a roll down from, we saw a change in open interest in the 91 strike, which is the 99.125 strike. So could be people rolling down, as well as some change in the 93 call, which also could be a repositioning on the futures curve as well. So that's what we're seeing in the rates here this week, Mark.
Thank you for that, Mr. Nick. And it's coming to the tail end of the show. That means it's time for you guys to join us with some futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome to the Futures Options Feedback. Like the name implies, this is where you guys get to join us here on the program with your questions, your comments, your pearls of wisdom, your insights for us and for your fellow listeners. A lot of good stuff to get to. Let's see how many we can squeeze in. Starting off, Nick, actually, our question of the week was very germane to this show, not just our pop quiz, even though people are maybe streaming, or maybe some people haven't been streaming. I don't know. The show, they're not listening, at least when they're answering our pop quiz. Votes are still coming in for the monthlies, so they must have missed us when we said it was the weeklies that are crushing it. So it's a back and forth fight right now between the weeklies and the monthlies. It's very close. That pop quiz has about an hour left to go. We'll see how it shakes up, Nick. But back and forth fight between the monthlies and the weeklies. Hint, if you listen to the live stream, you know the answer, so you get to win. Let's go on to the other question we asked this week, Nick, which is kind of interesting. Just expired a little bit ago. We asked our question of the week. We asked people, crude's moving around a lot, what is your preferred way to trade crude oil? Nick, we gave them the following choices. I'd be curious what you think won the poll, then I'll give you the actual winner. We gave them WTI options or futures. We gave them USO options or futures, XLE options or USO options or ETF, XLE options or the ETF, or Brent options / futures. What do you think won the poll, sir?
Oh my gosh, that's a hard one. I'm going to go with my CME group bias and go with the WTI options and futures.
Excellent choice. A close number two. The winner was actually USO. A lot of people out there still liking themselves the old ETFs, the ease of use. It's kind of hard to overcome some of that inertia. That won with about 54%. A third of people choosing WTI, so those are clearly listeners here of this fine program right here. And then 8% for XLE, only 5% for Brent. Kind of interesting there, Nick, that Brent doesn't really seem to resonate as much with the North American audience. It definitely seems to be more of a European product. Would you agree with that?
Yeah, just based on the exchanges where they trade, that makes a lot of sense.
I agree. Let's see what else we got here. Let's go. Oh, just quick one just came in while we were doing the show, Nick. You might want to comment on this one. If you guys aren't following Nick over there at Quikstrike1 on Twitter, you should be. He puts out a lot of cool charts during the show, as well as, of course, throughout the week. So make sure you do so at Quikstrike, at QIK, no C, STRIKE1. And you tweeted out a couple of interesting charts during the show, and someone, I think it was CJ Magnuson, asking you, Nick, what possible service could it be that generates these crazy visuals? What service could it be, Nick?
Well, that service is Quikstrike. So I replied to Dr. Contango, and I was assuming that he was speaking about the This Week in Options report, and I sent out a link there. So it's cmegroup.com/TWIO or TWIO, TWIO. Also, if you just go to cmegroup.com/Quikstrike, QUIKSTRIKE, you will see the other charts that we push out there during the week. Those are also available as part of the tools page that exists for everybody to use absolutely free of charge. So please go over there and visit. And if there's something that's missing, then give us a holler and we'll try to help you out and point you in the right direction. But you can find most of the things we talk about today, and most of the things that I put out during the week are meant to give you an idea of what's available for you to use on a regular basis.
All right, since we're hitting on platform stuff, we got a question here from Jillz with a Z. She's cool. She writes, can I get COT reports on Quikstrike? COT reports, of course, listeners, the commitment of traders reports. Those are kind of the standard a lot of people like to go by in terms of kind of base level futures and options insight into bearish positions, speculators, etc. What say you, Mr. Nick? I think I know the answer, but I'll let you answer. Can they get COT reports via Quikstrike?
Yeah, I'll give you the obvious answer is going to be yes, you can. And what you might not expect is that is also free. So if you go to cmegroup.com/COT, you will find the COT report is available there, and you're going to see any product that's listed, it has COT data associated with it there. So the one thing I will shout out that's not necessarily obvious from that report is we do have COT data for the ICE contract as well, and there's not a lot of good resources for that. So if you are interested in seeing that information, give me a holler, because I will have to do something special for you to get access to that version of things. But yeah, cmegroup.com/COT, and that gets updated about 3 p.m. plus Central Time. And if you really want to know exactly when it gets updated, follow us on Twitter at Quikstrike, QUIKSTRAKE1, and we tweet out when that report gets updated. If you go back and look in the stream, you'll see that happen a little bit after 3 today. So yeah, that stuff's out there, and there's lots and lots of versions of that report that are available, so you can really drill down a great deal. And we have the entire history of the COT report up there. So have a look, and hopefully you find that useful.
You're killing me, Nick. So much free stuff. When are you going to start charging, sir? Charge these people. You're giving it all away, giving away the store.
Well, you know what? There's plenty of good stuff that you can pay for if you want to come and take a look at it. So I figure, if we get people who are looking for something extra, something special, there's lots of good stuff up there that's well worth it. So give me a holler.
I mean, COT reports alone, people like that kind of stuff. People pay to get access to that stuff. So you're giving that stuff away, sir. You are crazy cakes. Let's move on to let's see, Beans. Got a question here from 7 of 9. I like that handle. I believe that's a Trek. It's a Trek reference. He or she, maybe she, because I think the character was a lady. She says, Beans, are beans still lining up nicely for hashtag risk reversals? Nick, if you think back a few months, we did a deep dive into, we did soybeans many times on this program, but even before this program was a glimmer in our collective eyes, we did a deep dive back in May, I believe, on our LSFO program that we do with our friends over there at CME, where we did a deep dive into all things soybeans, because it was just so popular. Remember at the time the beans were limit up, limit down, seemingly every other day. A lot of volatility, huge move in the underlying, huge moves in the skew. And the way it was shaping up, which is again goes back to why we were saying commodities are so interesting for a show like this, because there's so many different ways they line up. And the way it was lining up out there was, of course, all the fear, all the volatility premium, all the concern, call it what you will, was to the upside. So the calls were extremely rich, the puts not so much. So that lined up very favorably for collar/bearish risk reversal traders. You could buy a put for not a lot of volatility premium and keep it probably pretty tight. So you can get pretty tight protection, not that far out of the money protection, which is attractive, obviously, and then turn around and sell an out of the money call and maybe give yourself pretty decent amount of room to run on the upside. And because that volatility premium was elevated to the upside, you can probably do that for even money if you set it up correctly, or maybe even a credit, depending on where you lined up that call. So that was very attractive for a lot of long holders of the futures to be able to collar themselves like that. And for a credit, people will do that all day long. If you do that in traditional S&P, you have to pay for that protection. Everyone knows that the puts are very rich out there. We were just talking about that a little while ago. So the opportunity to get that for free or for credit, that's almost a no-brainer. And so that was very attractive to a lot of people out there. And I'm looking right now, Nick, at the volatility skew, the way it's shaping up. The call's still rich out there. You expect that to kind of be the sentiment out there in soybeans, but it seems to have lessened a little bit out there. And if I go into the old skew report here, I'll let you dive into quick skew in a minute, because like I said, it's not active right here right now. I need to set that up after the fact. But the old skew history, it was a lot richer, as we see back in the June and July timeframe. Overall net, depending on where you're looking on the risk reversal 15 or your traditional 50 delta risk reversals, where I like to look, and that's hovering fairly low, much higher than it was back in the June, July, and even May timeframe. Again, reflecting, I think, a little bit more premium for those calls, which is, of course, more attractive for a collar at the end of the day. So I'd say it's still, I think soybeans are always probably going to be, unless something crazy happens, you have an aggressive limit down movement and the puts somehow get crazy bid, something like that. In a lot of those scenarios, I think soybeans are probably going to line up to be favorable for collars, probably certainly more than your general S&P E-mini is going to on any given day. But that said, Nick, I think it probably looks a little bit less favorable now, perhaps a lot less favorable than it did back in May. What's your quick skew telling you? You concur with that?
Yeah, I'll push this chart out as soon as I am done, given whatever answer I can, just so I can concentrate on what I'm saying. But it's not as great as it was, but it's still, I think there's still some opportunity there. I mean, the 15 delta strike and I'm going to focus on the November contract there is still fairly high in terms of how rich it is today at the money. The 25 is not quite as high as it got, but there's still some juice there as well. The puts themselves, they're much tighter to the at the money. The big difference there being is that the 15 delta, and again, I'm saying these theoretical delta levels, but you can go on a pricing sheet and take a look and see which strikes match that. But the thing to keep in mind there is the 15 delta is now at a higher volatility than the 25 delta. So you have a little bit of a lilt in that curve on the downside. Before it was just sort of straight slash flat down, but you're seeing a little bit of skew out there on the wings. So again, disclaiming this right off the bat, but just sort of looking at things and remembering how I used to do things or how I looked at stuff. To me, this, if you want to take advantage of this trade without just doing the straight up risk reversal, you might look at something as buying the call spread, buying the at the money and selling something out there in the 15 to 25 delta range, and then also selling the at the money put spread and buying a downside put. So basically what that equates to is you're doing a risk reversal and then you're hedging it with a synthetic future. So what's going on there? Well, you're trying to take advantage of the fact that you're getting long something that is cheaper in relationship to that the money, and you're getting short something that's more expensive in relationship to that the money, and you're hedging it with a synthetic by having a long call and a short put at the money. So you can go out there and build that trade also for free if you register for Quikstrike Essentials from the CME website. There is a trade builder out there, so you can build that trade. One thing you cannot do in the free version is save that, but go out there and take a look at it, and you can go back and build it every day and see how it looks and see how it plays out. But I like that risk reversal still. You can do it selling the call, buying the put, and hedging with an at-the-money synthetic future. So there's some opportunity there, I think.
Gotta like that. Wish a few equities would line up that way, and it would make much more attractive from a hedging and from certainly a collar income generation perspective. A lot of people would like that, but unfortunately, Mr. Nick, that music means it's time to bring to a close this grand sojourn through the world of futures options. We always say a half an hour, and then we end up getting into some cool stuff, and we end up going a little longer. I don't mind. I think our listeners don't mind either, as we go a little longer all the time. But it's always fun to do a deep dive into all things futures options. But before we go, Mr. Nick, you mentioned a bunch of cool stuff you're working on over there. You talked about commitments to traders. You talked about a bunch of other stuff. You talked about the quick skew, obviously. You guys are always cooking up cool stuff. What are you cooking up that our listeners may be interested in over there in the land of Quikstrike?
Okay, well, good. I actually have a longer answer today than I usually do. So I think some cool stuff that you're going to see near term and probably inside of probably not this weekend, but next weekend. We got to get the exact schedule on it. We are, here we go. Now my phone's ringing while we're doing this. Sorry for that. We are going to be releasing a heat map. And that heat map will encompass not only open interest in volume, but also volatility, prices, as well as open interest Greek aggregates. So you'll be able to look at some really cool stuff coming up here in the near term. In fact, right after the show, I'll put out another picture or retweet a picture that I put out earlier today, or a chart that I put out earlier today. So I'm looking forward to that going out there. That's going to be available. Yes, it will be available for free from the CME Group website in limited capacity. So we'll put it out there. And in order to get the real nuts and bolts and meaty controlling part of it, you're going to have to come over to the dark side on the subscription basis. But you will probably get more than you will get anywhere else with that. That's coming out very soon. Also, this weekend, the open interest profile tool that's already out there, that's going to get a couple enhancements in terms of, like I said, showing the max OI contracts, as well as adding a max pain report. And if you want to know what max pain is all about, just go out there and search max pain, and you will see what that means and how people look at that in terms of trying to figure out where the market is going to push the underlying. So some changes to the open interest profile tool, some new heat maps coming out, adding some new products coming in the next, some new index products coming out in the next couple weeks. And we will be, if anybody's interested or there's any users out there, we will be merging the weeklies, the regular monthly contracts, and the months into one S&P, NASDAQ, and product. So it's a little bit easier to look at that stuff and to compare them and to, really start to do what Mark talked about today in terms of looking at them and how they relate to each other from a volume and open interest standpoint. So a little bit longer answer, but I think some really good stuff coming down the pike.
Good stuff, as always, sir. Check them out in the land of Quikstrike if you haven't done so already. Easiest way to kick the tires, as Nick said, for free. CMEgroup.com/TWIO. This week in options, you get all the stuff we're talking about pretty much for free. All the stuff Nick just added pretty much for free as well. It's kind of ridiculous. A few of you kick on over, and once you start playing with the tools, I think you're going to want to go on over to the mothership Quikstrike for all the cool stuff. You guys get a heck of a lot of stuff over there, that page. So don't take my word for it. Kick the tires yourself and see if you like it. And give him a follow over there on Twitter while you're at it, at Quikstrike1. No C. For all the charts he tweets out throughout the week, not just during the show as well. And on behalf of Mr. Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course, sending in such great questions and tweeting them and all the other fun stuff you guys do. Keep them coming, and we'll see you next week right here on TWIFO, This Week in Futures Options.
This Week in Futures Options is brought to you by Quikstrike, options pricing and analysis software. Quikstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quikstrike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quikstrike is the perfect addition to your trading toolkit. Learn more about Quikstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quikstrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.